Hi, I'm your host, Sophocles Sophocleus. On this podcast, we discuss interesting stock ideas from around the world. The goal is to have meaningful discussions by getting into the numbers and better understanding the opportunity. Thank you for joining us. This podcast is being made available for educational purposes only. It should not be used for any other purpose. Full disclaimer at the end of the podcast. Welcome, everyone. I have here today my good friend Adam Siegel and Brian Angst. And am I pronouncing that correctly, Brian? Angst. Okay. So Adam and Brian work together at Esoterica Investments. They've worked together for many years at Bear Stearns and JP Morgan. I met Adam some years ago in ValueX Clusters, where he presented an investment idea, and it was debt related. And I've spent some years in debt, and immediately it clicked with me. This is a smart guy. I have to ask him about this idea. And about a month ago, we were talking about a trade that they had put on, and it's good to mention right off the bat that Esoterica does not have outside money. It is their own money that's on the line. So he was explaining to me this trade and what was he saw going on in the market, and I thought, wow, this is fantastic information. I said, Adam, I mean, would you mind doing a podcast? I think a lot of people can learn from what the trade that you had put on, and we all become smarter. So, Adam, Brian, thank you for doing this.
Oh, thanks for inviting us, and always appreciate your thoughts and friendship over the years. So thank you for inviting us into. Brian can just jump in however you want to talk about, but I think a little bit about our background is helpful just to understand where we're coming to this. But so Brian and I started working together at Bear before the financial crisis in 2000. Well, Brian had been at Bear for a few years before me, but we started working together in 2006, and we worked in the commodity group there. And one of the things that we took away from that, there was a couple of things. One is having worked through the financial crisis and having essentially had a front row seat to the financial crisis gave us a lot of insight, and those happened fairly early in our careers. So it was something valuable to learn. And the other thing that was important about the group that we worked in, it's something that I don't think is going to be replicated in the same way for, I don't want to ever say again, but it's going to be hard, is a physical commodity business inside of a Wall Street investment bank. And the benefit of that was seeing it's a juncture of a true physical operating business, whether that be gas storage facilities, power plants, transportation assets, things like this that we owned and operated, and also analyzed with a financial overlay. So the technology that you would see in a bank with respect to derivatives trading, hedging, analyzing physical assets with that type of overlay. It's a juncture that gives us a lot of insights, because I think when you see a lot of people who trade options, it becomes very technical, and it becomes something that looks almost like you need a degree in physics to participate in it. But having come from that background at Bear, which was itself a pretty practical place, it was a very down-to-earth bank, I think is a good way to describe it amongst the bulge bracket Wall Street banks at the time. This was a place where you could really see the two pieces come together and understand how can you use these tools, these financial tools, in a practical way in business to make the business better or to manage risks better, and not to use them in purely financial engineering machinations that look like you just got to trust this physicist that he knows what he's doing. Otherwise, it's a black box. So that's the world we came from, and we started working together again. It was a year or so ago now. We took that same view towards the market into our business now. So we look at fundamental businesses. We look at businesses They're generally pretty simple businesses, but going through transitions, periods of stress, and then we also look at opportunities like we're going to describe today.
So, and I think you can even expand on that a little further, because prior to Adam coming to Bear Stearns, he was at Enron.
That was actually my first job out of university was at Anast. So it's a good point. I've seen 3 crises.
Yeah, so together we've been on the front row of the dot-com crisis, Enron's blow up, Bear Stearns blow up, which coincided with the global financial crisis. What I'm going to say is that that experience has really colored our thinking about how important loss avoidance is, and also that crisis is not always just about trying to avoid losses. It's also the period that provides the most opportunity to investors like us.
Right. We were talking about, before we came to the podcast to speak, we're thinking, well, how do we explain what we do to people? Essentially, we either are running into burning buildings, trying to save valuable assets. If the business is on fire, we're running in, not running away, and we're looking for things that can be saved and salvaged out of the crisis. Or, as in the case of the trade we're going to discuss today, we look for where the crowds are gathering. And we try to understand if the reasons why the crowds are gathering in a certain place is something fundamental that makes sense. It may not be our business to invest in it. We may not understand why Amazon is a great business, but I recognize it could be, and I'm not going to fight somebody who thinks it is. But there's other things that attract crowds that are more like carnival attractions and carnival games that aren't really beneficial to the people who participate in it. And we really like hacking those games. We really like figuring out, how does this thing work? How are these people making money off of it? And can we invert that and flip it on its head and figure out how to take the other side? And that's really this trade. Yeah.
Yeah. So you're trying to be the house when people are gambling, or trying to figure out if those people have an edge. So you're just trying to make a decision whether to be the house or not with each trade.
Right.
And I think just understanding from a few other investments in the past, I sort of categorize you a rule number 1 type of guy, trying, maximize my payoff, minimize my risk. So what have you seen that the crowd has been rushing in, or the market or banks are trying to sell that, seems to attract your attention?
Seems like the Carnegie, is it too good to be true?
So right now there's really a lot of different flavors of the same trade, but they're all essentially short option trades that are selling volatility. And we see that targeted at the retail space, and we also see a parallel to that in the institutional space with hedge funds and pod shops.
The interesting thing is the way that we came upon these particular types of instruments is we are very focused on tail risk hedging. Because like we said, we believe loss avoidance is the most important thing to keep your compound annual growth rate positive. We don't focus on beating an index, we focus on maximizing absolute returns. So in a given year, we're okay with making a risk-free rate. We just want to load our portfolio with a bunch of positions that have these embedded options that will spike and pay us off big. Whenever these events that the market prices as unlikely happen, which we believe happen a lot more than expected. So anyway, because we have these tail risk hedges on, we bleed a lot of theta. We pay a lot of premium in order to cap our downside. And as such, Adam said, look, we need to find some yield, some high yielding investment.
We need to get some alpha in the book, some non-systematic exposure. So we're starting to pay back what we're paying out in the theta.
Yes, so that will offset the premium that we have to pay. So what we did is we started looking for things with high yields. And we took all the ETFs and mutual funds and ranked them by dividend payout. And that's where we came upon these particular investments that Adam started talking about.
it wasn't necessarily from the point of view of saying we would actually buy any of those things day one. I just wanted to see, like we talked about, where's the crowd going? Where's the general public going for 15% yields? And let's see what those things even are and try to, reverse engineer or try to hack those and see what's really going on there. And when we went through a lot of those instruments, you see, high yield corporate debt with very tight spreads that did not seem to reward very well for default risk. We saw commercial REITs, whether it be mortgage REITs or underlying properties. We were very uncomfortable, and we actually have a different trade related to commercial real estate, but we were very uncomfortable taking that exposure. We saw residential mortgage REITs, which have a very unique kind of yield curve shaped risk to them, because the yield curve is inverted, and these are dependent on a positively sloped yield curve. And it's a bet on when that yield curve flips to a positive slope again. And I don't have any way to predict that, but that is really what those REITs are dependent on. And then we found at the top of the list actually was something that really surprised me in both the magnitude of the yield that they're paying and also the number of funds that are doing this, which is paying so-called derivative income ETFs. In its most basic form, and actually the largest ETF in that universe, is a very simple buy-right ETF. They have a long position, in this case it's a long position in the NASDAQ 100, and they systematically write calls on that index. And it generates a yield of about 13, currently it's about 13% dividend yield. An example of one of these derivative income ETFs. And that space of just the ETFs, and I want to stress that is a sample of the population. The total size of that ETF universe doesn't represent all the capital that's in this option selling space, but it has grown by tenfold, 10x in the last 3 years. So it's had a 10x growth in 3 years in AUM of just those ETFs. So that is not including the insurance companies offering variable annuities that track that strategy. Is not reflecting the brokerage houses that are selling structured notes tied to that strategy. But these are things that in their totality are short vol. They're short options, and they try to generate income by doing that.
So just to understand, so you're talking about probably at least 100 billion just in these ETFs, not taking into account private banking, other, structured products, et cetera, which is essentially just a covered call strategy, long the stock, write the call. If the market doesn't move, I make a little bit of income. But if the market goes up a lot, then I miss on the upside. But if the market drops, then I lose money. So I'm limiting my upside, but and I'm not protecting myself on the downside. And if the market drops, I miss out on all the big years, and that can be a problem. I think we had this discussion.
It's kind of the opposite of the kind of positions that we like to put on. And you might ask, why are people doing this? And, from our view, it's simple. It's retirees that are just sorting by the dividend yield and saying, wow, I can get a 13% dividend yield and still have exposure to market. And what they don't realize is they're really clipping off the right side of the tail. They're giving away all their upside for that 13%. And for a while, volatility has been really, really low.
Yeah.
And so it also provides really high Sharpe ratios, which also interests a lot of the pod shops that are just chasing these different metrics, putting their money into the flavor of the month.
The pod shop strategy is a little different than this. It might be more complicated than to describe here, but it is essentially selling tail risk. It's focused on the correlation between the index and the components to the index, and selling index vol and buying component vol. But it accomplishes the same outcome of people net selling options, net selling in this case, they're selling tail risk.
So basically, if you select, the period you want to show, I guess, your client, you can show something which just looks fantastic. But then if you take a longer history, then this doesn't look too great, is basically what I'm taking away here, versus just being, let's say, long an index ETF, holding.
Well, I was going to say,
holding.
I was going to make two pieces of information available that I think would crystallize it. One is the actual price graphs of the two instruments over, what is that? What did we do, 5 years?
We looked at this large ETF, which is QYLD. It's the largest ETF in the space, and we looked at it over the COVID cycle. So from December 2019 through December of 2023.
What was the performance if I held, let's say, just the QQQ versus if I held the QYLD, which does this trade?
So if you were long QQQ over that period of December 2019 through December of 2023, a 4-year period, you would have had a 92.6% capital appreciation. Not the total return, but just the shares would have appreciated that much. The QYLD over that same time period, you would have had a loss of 26.6%. Your net position in the QYLD would have benefited from the dividend that was paid, 13% a year, but it would have resulted in a 20% total return over that period. And the QQQ pays a de minimis dividend. So you could compare it, it's very similar. A 20% gain versus a 92% gain on a total return basis. So you would have lost a significant amount of upside. But it becomes more insidious than that, because what happens is your exposure is all in the downside in those indices. When you had, for example, like that Q1 of 2020 period when COVID hit, QYLD and QQQ went down by the same amount on a percentage basis. But you did not participate in the upside, the massive rally that the NASDAQ had over that following period. You did not get to participate in it, because when it would have a strong move up, you would be capped out at whatever you sold the call at, plus some premium that you collected in selling the option. So you continually are bumping up against this amount, and the longer you hold that position, and the more market cycles you see and the more volatility you see, the more that effect starts to erode your compound growth rate. And this is what we were talking about at the beginning, this psychology of why loss avoidance is important, is because losses destroy your compound return more than an equivalent gain can. It's a very simple concept. When you say, well, if I lose 50% in 1 year, in order to get back to flat, I have to be up 100% the next year. So that loss on an individual basis in a single year is very hard to overcome in the following year. If you buy this QYLD, all you get are those losses. You don't get, like Brian said, you don't get the right side of that return distribution in order to fully recover those losses and start to build back. You just keep getting capped out at your call strike.
And you've shown here that based on what really happens in the real world, it's not a great strategy. So you've come around to basically take this apart and say, okay, well, if this is a bad strategy, how can I make money from this? And how can I do the opposite? Is that right?
Yeah, being good value investors, we always invert. So we're trying to figure out how to invert this and make a slow decay of value into an accretion of value. One approach we first looked at was to just literally invert this position. So go short the QYLD and go long the QQQ. That position has some negatives to it. So in that instance, you will make you short QYLD, long QQQ. You'll make money when the market goes up, and when the market goes down, your losses will be capped basically at whatever you have to pay out in dividends on that, essentially replacing the option premium income.
So you're paying it, like if you're short QYLD, you're paying a dividend every month.
Oh,
Every month.
oh,
So
oh.
Well, it's 13% annualized, so
So-
you pay that amount out monthly.
So over a market cycle, we think you'd still end up a winner, but you got to make it.
You thought of a better trade than that.
Yeah, you can't get blinded out before the market cycle.
That's an expensive position to hold. It kind of does the opposite of what we were looking for in some ways, in that we're looking for something that we would be confident would produce income over some sort of a known horizon. This one does the opposite in some ways, in that you're going to be paying out more cash over a known horizon, and you might make some, and you eventually will make it back, but it's over an unknown horizon.
Mm-hmm.
And it's only when the market goes up that you would make that.
But there's consequences to all these funds trying to do the trade that these guys are doing, the QYLD. So what were the consequences of that, and how then did you come up with the actual trade you put on?
Right. That's a very good point. So collectively, the result has been a decline in implied volatility in the market.
And the one thing you got from talking with you, Adam, through our chat, when you're buying an option, you're basically agreeing to a certain volatility. That's the implied volatility. The implied volatility basically goes into the option price. And for you to make money, if you're long, then you need the realized volatility to actually be greater. So when you're putting on an option, it's a bet on volatility, essentially. Do I have that right?
Yeah,
you got it perfect.
And the way I think about it practically is, when you enter into an option position on day one, there's a fixed strike price, and you're striking a bargain between two parties that are trying to decide what the probability is that the share price of that stock or that instrument will go through the strike price by the time the option expires. So it really depends on the daily variance of the price move. So how much is that going to move day to day? And if you assume each day there's a probability it can go up or down, it's a question of the magnitude of those daily moves. So if you start to move through the strike, what is the probability that will continue to move through there and expire in the money? And that is what you agree to day one, is what that probability is of the shares going through the strike. And people call it volatility. It's really a description of that daily price move.
So if everyone goes and sells an option, they're pushing down that implied volatility.
Right. And what that means, because the implied volatility is a description of the daily price range, the amount that the price can move. So the lower the volatility gets, it's saying that every day they're betting that the price of that stock will not move very much. If you think about what it would mean on this distribution, it has a wide bell curve right now. The tails are wide. Volatility gets lower, that standard deviation of price, the variance of the price move, gets smaller, and that bell curve gets more peaked. And it's saying that the path that those shares have to follow going forward to avoid the option going into the money becomes smaller and smaller and smaller. The price of those shares becomes very path dependent. You have to follow a very narrow path in order for that option to expire out of the money. And in our vision, in our experience of the world, that doesn't tend to happen. The more people plan on a very specific thing occurring, very often it does not play out that way. Whether that was at Bear Stearns or Enron or anywhere else, or any other blow up that you see in the market, things generally don't tend to follow, despite the expertise and the brilliance of the people there, or the battle-hardened, professionals that are there, things don't always work out. And when you have a low volatility environment, you become very path dependent on the shares in the market. And I know, sometimes, and I've seen some of the work like you've done, Sophocles, where you deconstruct some of the well-known multiples in the market, and you say, well, this implies a certain growth rate. If you had a PE of it would mean that the shares would have to continue to grow at some rate in order to realize that. And it's those kind of things when you have a high PE, low vol environment, high leverage environment. All of these things are like creating path dependence. In order to achieve those outcomes, you can't have much go wrong with your plan. Like it has to follow that path. And what we're looking for is those kind of scenarios where, for whatever reason, the market has decided this is the path, it can't change from that. Whether they did it by design, like maybe someone that's very focused on high growth companies or something would bid up PE and make it very dependent on a certain growth rate achieving. Or in this case, people trying to target yield inadvertently or as a side effect, driving down vol in the market, implied vol in the market, and making the market very path dependent. And we've seen that, we just described the 10x increase in ETF AUM for derivative income. I think that's indicative of a bigger growth in the market, not just in the ETF space. And you also see it in the tenor of options. So the tenor of the option, the term until expiry, over the last 5 years has become very short, up to the point now one of the most popular option tenors in the market is 0 days to expiry. So options that expire within the day. And the effect of this is to compress the volatility into a very short time horizon. When you have an option that expires on short order, the value of that option swings wildly with small moves in price. So when you have that expiry brought to intraday period, volatility gets compressed into that time period. So when we looked at what is the implied volatility in the market that we're seeing induced by these option selling strategies versus what is actually being realized in the market over a full daily range measure of volatility. So if we say that implied volatility is what it is a representation or is equivalent to the expected daily price change, we can also then look at what actually is the daily price change in the market over that full daily range, the intraday period, not just the close of the prior day to the close of the current day, incorporating the high and the low and the open for all of those days. So when we do that, we see actually a much higher volatility realizing, and it's more stable. So it stays higher, it is higher, and it stays higher. And that really is the core of what we did with this trade, was to buy implied volatility that we thought was very low in price and very path dependent, and we were going to earn that full daily range volatility. That was our plan going into this trade. So we would earn the difference in those two, the expectation of a low daily price move and the reality of a high full daily range price move. We use the S&P 500, most liquid market, super tight bid-ask, very low cost to transact.
And the only way you earn back that high realized volatility is by delta hedging. So we put on a straddle, we had long implied volatility. When we looked at implied volatility, we saw that it was trading below, one standard deviation of the mean for the past 3 years. And then a lot of people looked at just close-to-close prices for historical volatility and said, well, yeah, historical volatility is even lower, and it always comes in lower. We looked at the full daily range, and we said, look, that comes out a lot higher, and we think we can earn not only back the premium that we put on by buying the straddle, but more than the premium, and have all these other goodies that are baked in that we can reap when unlikely things happen.
You're going at high intelligence speed.
Sorry, I thought I was trying to summarize it quicker.
I'm not as smart as you. So just so people who are listening can follow along when we're talking about a straddle, because like I said, we barely, most equity guys probably don't even remember beyond delta. So maybe, or whoever's listening. So when we're talking about straddle, I mean long call, long put.
Yeah, at the same price, same strike.
At the same price. So you guys did your own calculation using like the SPY and looking at what was the full daily range, what was the range of each day going back a few years, and comparing that to what was the implied volatility in the calls, in the puts, and you figured out that because the implied volatility was suppressed a lot, both on the calls and the puts, you were able to put on this straddle and delta hedge it. Delta hedge being, buying and selling the corresponding shares so as to not have exposure and then just earn from this implied versus actual volatility. And so your trade, the straddle long call, long put, because of this very low implied volatility based on the research you've done over the last few years on the SPY, which has become a result of all this option selling going on, presents this opportunity. Maybe we should go into like an example of the trade.
Well,
Is now, or do you want to say something else?
Yeah, no, I think that's a good segue into an example. But I think back to your original question, you were asking, like, you saw implied volatility low, and so, why did you do this? And I think you could look at it as two ways. All implied volatility is low. You could just buy the put and the call, buy the straddle, and then just ride it to expiry. But as you're doing that, like, you're losing your premium each day.
And you're taking a directional view on the market at some point. If it starts going in one direction, you want to be agnostic to price direction. We're not trying to predict the market is going to collapse or the market's going to rally. And that's one of the reasons why doing the structure with a short QYLD, long QQQ, you're locked into making money only if the market goes up. So we wanted to own the straddle, both sides of the, we want to own the entire construct so that it could profit regardless of how the market moves.
Yeah. And so,
I see. So there's actually, it's like different levels. So the one level, like when we started talking about this, is that, this is not a great strategy, this, selling calls and owning the underlying, which is evident from the performance we talked about in the QQQ versus the QYLD. And, step one, you could do the opposite of that. But that has a lot of cash outlays, et cetera, et cetera. So, step two would be, you can just go and put on a straddle, long call, long the put. You're expecting volatility to happen, so you can do it that way. But being your conservative nature and you wanting just to play that volatility side is, in addition to putting on the straddle, you're also buying and selling shares to just focus on that volatility and reduce
that's
your
the
exposure.
differential. What we're trying to, this all may sound like crazy talk for someone who's not used to options, but this is at its heart a value investment trade. No one seems to want to own volatility, implied volatility. Everyone wants to throw this thing away and discard it. And we said, no, this actually has value, and the value is this full daily range. There's this characteristic of the market that's also being driven by this other phenomenon. It's like, equivalent of investing in a company. You're like, there was this old, fussy, tech company, and nobody really knew there was an AI division inside of it. And you can buy it for this low valuation, which is what we're doing. Nobody seems to want to own this volatility. But did you realize that the fact that 0 day to expiry options are as hot as they are is actually causing the full daily range to explode? And we can actually capture that by buying this really cheap thing that nobody wants anymore. And that's what this trade is. It has a lot of technical elements to it, but at its core, this is a value trade. We found a hidden asset, so to speak, inside of this typical implied short option. Nobody seems to want this product anymore.
So the straddle, is that on 0 day that you're putting on?
It was a 7-month trade. We put it on in end of May.
7 month.
For December.
And then it was a December 20 expiry. Just put the numbers around what we're talking. So, I think implied vol around that time was like 12 and a half.
Yeah.
if you looked at the close-to-close historical vol, it was coming in not too different from that.
Close to close, yeah.
But if you looked at the full daily range, I think when we backed it into a similar IV or similar volatility, it came out to like 21.7, 21 and a half, 21.7, something like that. And so like in our mind, we're thinking, okay, if applied vol is low, it's one standard deviation below the mean, we can buy this, and if we dynamically hedge it, and it comes out, historical vol comes out as low as it has been, we can make back our premium. If we can actually take advantage of the full daily range and realize that 21.7 vol, we'll make a fair yield to offset all our tail hedges and produce return. And if you have these strange actions from all the different activity that's coming up with the Fed and the election and everything else, you can have a vol spike, and then we would make outsized returns. I think the easiest way to think about that is to fast forward to the day of expiry of this strategy and think about what happens as the price pings around. And so we put this thing on at 5:30. That was the at the money strike. That was where the market was trading for SPY. So think about on day zero, if SPY goes to 600. Well, all of a sudden, you're $70 in the money. Let's just say we have one unit. You're $70 in the money. That call is now worth $70. So how do you lock that in? Because you still have 8 hours before the end of the market.
Right.
So you do that by selling the one share stock. The call has become delta 1. The delta of the put has become 0. So you just sell one share. Now, if the price goes back down, well, you made money from selling that one share. You made the $70. You've locked that in. Same thing happens on the reverse side. If it goes down another, $70 to what is that? 460. You're going to be delta 1 on the put, and you're going to buy those shares. So then if it moves again, you're going to rally.
And this is the effect when you see these 0-day to expiry options. You have these wild swings in delta based on small moves in price, and that relationship is called gamma. As you get closer to expiry, that gamma starts to increase, and it's that process over the whole life of the trade, every day, throughout the day, of rebalancing that position. You'll earn those values that Brian just described. Over the life of the trade, you'll earn back the premium you paid if those daily ranges are equivalent to the daily range that you struck the bargain at when you bought the option. So the implied vol that you paid day one for that, the premium you paid for that option, is equivalent to an implied volatility. That implied volatility is equivalent to a daily range of price, an expectation of a daily range of price. If in reality, the daily range of price that gets realized over the life of that option is higher, you will earn a positive yield. And
just to understand this trade example, you do put on the straddle, long call, long put. At the start of the trade, do you also delta hedge from the beginning?
We also delta hedge from the beginning. And in general, that straddle won't have a very high delta at the beginning because it's at the money and you own both sides. But in general, the put is a little more favored. It tends to be in the market. The delta in this case would have been short.
Here's to make it easy. The delta on the put will be minus 0.52, and the delta on the call will be plus 0.48. You net those two out, and you do have a resulting delta position, but it's small. It's very small. A lot of times when you think of straddles, you think of them kind of as delta neutral. They're not exactly, but they're pretty close.
And there's
Okay, so you might buy a little bit of stock to offset that minor negative delta.
You are correct. That's correct.
Long the call, long the put, and that resulting position gives us a slightly tiny negative delta. Then I go long some shares.
Yes.
Did you do that within the trade, or did you just say it's zero?
There's only a certain number of strikes. The increments of strikes aren't like pennies. They're, I think in this case it was $5 increments. So we had the market when we put this on wasn't 530 exactly. It was 526 or something.
Yeah.
So
the underlying market for SPY. So we had to choose a strike that was closest to that.
So we had a positive delta that we had to neutralize by selling short when we first put the trade on.
Okay, understood.
And then the market from that point kept rallying higher. And so, we in general had throughout the entire life of the trade, we were positive deltas that we were neutralizing with short sales.
Wow. So then, the delta over time was going up since the market was going up, and you had to add to your shorts until, I guess, recently.
Yes, and what we talked about a few minutes ago was that our expectation going into the trade was to earn this realized vol on the full daily range, and to earn a return on that based on what we pay for the implied vol. There's another way that this trade can make money, and to use the terms we were using before, that is the gamma. You make money on that trade with the gamma of the options you own. You're also at the same time, because you have these long option positions, and you can sell the options themselves. You don't have to wear them and hold them through the maturity or the expiry of the option. You can resell them. And the price of those options is the premium. We could resell them and sell them for a premium. And that is the implied vol. And the relationship of the option value, the premium that you would receive for the option, and the implied vol is called vega. So we also have positive vega in the position. So what happened a few weeks ago with this Volmageddon 2, or people are throwing around different names for it, but we saw the implied volatility in the market spike, once in 20 years spike or something like that happened. So we had exposure to that spike. It wasn't just, because one of the interesting things about that was it did not really move the underlying price that much in the indices. And for all that explosion in volatility, most people that you would have seen commenting in the news and things like this said you would have thought that the whole market should have dropped 10 or more %, but it didn't.
Oh yeah, exactly. VIX went to 66 or something.
Yeah, very rare event. But the price of the stock index itself did not collapse. But we actually had exposure to the spike in the volatility through the vega and the options. So we sold the options themselves and just closed the entire position, and it was more remunerative. We earned more doing that than we would have harvesting that full daily range gamma out of the position. It was a rare thing. It wasn't something we had planned on. We can all speculate on why we think it happened. A very vol-specific event. There was people getting squeezed out of those specific trades that I think.
Yeah, I mean, you would need some serious declines to get that VIX. It didn't affect the cash market itself, but affected in a big way the options, and it really helped you guys make a nice return on that. Now, just before going further, let me ask you, like you said in the example, if the price goes up, you're selling, comes down, you're buying it, you're locking in that return. So were you essentially kind of day trading the SPY?
It's different than day trading. And look, it is.
We weren't predicting the direction of price.
Yeah.
It was very mechanical.
It was look at what the delta, the net position is. So that would be both your put and your call and any ancillary deltas you had already put on. And then, you just hedge it out. And you got to be pretty diligent about hedging it out. It's a very high touch position.
Okay. I see.
But it's not
predicting.
It's also hard to get in the mindset of, look, it gets to X number of deltas. I know what the transaction costs. Now's the time I got to hedge it. Because you're thinking, well, shoot, every time you do hedge it, you're clipping some of the profit if it keeps running that way. And you think, what if it just keeps running? I'd be better off waiting to hedge. Yeah. The fact of the matter is, we can't predict the market.
No.
We don't know if it's going higher or lower. So you got to be diligent about just hedging out your delta.
I get it.
The entire trade is about, when we put it on, was about one thing, which was we saw that the implied volatility was being repressed and it was a good value to buy it. It was not about the price direction. It was not even about, we talked earlier about tail risk hedging and about buying, protection against a massive drop in the market. It was not that. This trade was specifically about our informed analysis and valuation of the implied volatility in the market versus the full daily range. So we saw this is what you would actually earn. The earnings power, or however you want to describe it, was the full daily range. And we were able to get that earnings power for this very low implied volatility price. And it just a lot of work and a very high touch position in order to earn out that full daily range. We had to sit there and manage it day to day, but it was not about, well, is it going to close higher or lower at the end of the day? It was just literally look at the blinking number like a monkey, and if it blinks red, hit the button. If it blinks green, hit the button. And if we were more astute computer programmers or things like that, this could have easily been automated in an algorithm, but we're not. But
so you're not high-speed trading quant shop.
No, and you look on first blush, this trade also might look like, we're trying to be dealers, and we weren't. This is actually a very, very good example of the type of investments, type of value investments that we want to do. There are many instances where this exact trade we wouldn't put on because we're not dealers. And if vol's high, we don't want to have to be obligated to provide liquidity to the market, the option.
So basically, you don't have a chart there and you're measuring the range of the day and you're trying to play around and day trade or whatever. You are, basically managing, you're doing risk management at the end of the day, managing this on a daily basis, looking at the delta of the position. So I'm guessing this was, you were managing this throughout the day. Or was it you didn't think I'll do this at the end of the day? It was very dynamic.
We would trade off managing it. We would make sure that somebody was watching it at all times.
It has to be intraday because that's the whole issue. Is if you look at close to close volatility, so the close of the prior day to the close of the current day, you don't see that action. And it's because of the move to 0 day to expiry options, you have a significant compression of that volatility into the intraday period. And I think, we talked about it I tried to, inquire, like even in your Cypress group chat, Socrates, about, you see certain single name stocks would have these massive moves within the day. And they would be fairly mundane companies. And you'd see a 10% move in the day. These are things that are pretty dramatic. I mean, that's not names that are very heavily followed. I'm trying to think of one. I think Nike was one I remember asking someone about. How is it that with all the analysts that follow this name, they just got taken by surprise? It doesn't seem reasonable. And I think it's this phenomenon that there's a lot of leverage implied in options. It's been compressed into a very short time horizon, and it can cause violent swings, but it's now in the intraday period that you see those swings. And we believe, if we realized on that intraday volatility that we saw persistent, we saw the reason for its persistence, we could earn back over the life of the options that we bought. We thought it was about a 15 to 16% yield. That's what we thought we would earn on this. Harvesting out that intraday realized volatility. And in addition to that, we got these added features like being long Vega, which we didn't think we would ever have a reason to capitalize on. And we did. We capitalized on that a few weeks ago. And the trade had a very surprisingly high return for us. It wasn't part of the plan, but that's how it worked. To Brian's point, even if that full daily range came in lower, it would have to come in significantly lower than it had been. And by significantly lower, close to half of what it had been, for us to have lost the premium that we paid. We would have broken even on it. So it was a good risk reward, we thought, and a good way to earn some yield. So to bring this all back to where we started, we were looking for a way to earn some yield in the market in a safe way to protect principal, which is core to what we're doing. And we thought realized volatility on a full daily range basis would have to come in materially lower, shockingly lower, in order for us to start to lose money. And if it came in at the levels we had seen it realize at, we would earn something like the yields that we were seeking, to recover, the 15 some odd percent yields. And in addition to that, we have these unexpected ways we could make money if, a once in 20-year event happened, and it by pure dumb luck happened. The once in 20-year event.
Well, we all know volatility happens a lot more frequently, I think, than people think, or is implied, I guess, at the end of the day. Now, so let's just playing devil's advocate here, and just to fully understand. So, applied volatility is below where it has been, etc. Fantastic trade idea. And what if, central bank, cut interest rates and it's off to the races, and just volatility, just doesn't drops even further.
I would say any events like that actually would increase volatility. It was unexpected. Maybe now a little bit different.
Well, it would increase so the thing that is hard the thing that makes this conversation difficult is the term. So because everyone in general seems to equate the VIX with volatility. So when people say, well, if central banks become very accommodative, the VIX will fall and the market will go up. But what we're describing is a scenario where we're looking at this intraday range and the realized value within that. So we thought that was actually a very stable number. So if the trade had been purely on Vega, if the trade had been purely us saying, we're going to buy the VIX, easiest way to say it, we're going to buy the VIX. We're going to buy at the money 30-day implied vol, the daily mark on that, the daily price movement of that. And the central bank became more accommodative, it's very likely that that index would fall and we would not make money. But what we did was we bought a single point in time implied vol number, and we're going to earn back through every day within the day, harvesting the gamma out of position, the amount that we paid for it. And if that number in the futures for the implied vol went down, it's not really that important to us. We're not going to sell the options at that price. We're still going to earn back what we were going to make on the gamma of the option. We're going to still earn that back. We believe we got enough of a head start with the amount of the intraday range that we would earn. And on the flip side, if something bad did happen and implied volatilities did spike, we could sell the options, and that is what we did. But it doesn't necessarily mean that the full daily range would get compressed below the price that we paid for that when we bought the options.
And so you're asking worst case scenario, like I think we were benchmarking at either breaking even or making risk-free rate.
I see. Yeah, you're not trading the VIX. You have a position where you're active with it, and it makes a lot of sense to me, because I think when I'm looking at companies, and I find some companies that I really like and I don't like the valuation, and then I say to myself, yeah, that's okay, because it's going to come back. Markets are volatile. So you are just like entirely embedding that essentially into one trade. Now, let me ask you one other question. I'm not sure if this goes off on a tangent, but I think I'd like to understand this, because you've mentioned to me like the dispersion trade, which is like selling index options and then buying options on the components? Because that's also another trade which has been going on. I understand. So, and
Yeah.
that bets on declining correlation. Can you say
Right.
anything about that, just so we can
Yeah.
better understand in our heads how that works?
So one thing, idea of, show, I'm going to butcher the quote, but show me the incentives and I'll show you the outcomes. Is that the quote? Something like that. The famous,
Yeah. Munger,
yes,
right?
Munger, right? And so, in the case of the retail situation with those ETFs and the strategies like that, the incentive is yield. And you saw these articles in the Wall Street Journal where the folks on Wall Street that sell this stuff call those products boomer candy. It's like candy for all the baby boomer retirees, and that's the incentive. They want to see the yield. So here's a product that will give them yield. It doesn't necessarily give them capital appreciation, but it gives them yield. They ask for an incentive, and this is the outcome. And a trade like the dispersion trade generates really high Sharpe ratios. When you have a market that's generally increasing, generally going up, and you have volatility generally low, those types of trades that are net sellers of volatility will generate pretty high Sharpe ratios and will attract capital. Whether they work over full market cycles, whether they will work in a once in 20-year vol event, those aren't things that are generally parameterized in a Sharpe ratio metric. People will look at that and say, well, this trade is working, give it more money. And in this instance, we saw it's been really well covered, but the indices have become very concentrated. You had a dispersion. I think you can just search in Wall Street Journal, and you see many articles about the Magnificent Seven or the Magnificent Five versus the other shares in the S&P, and you can see them going in their separate ways. So this trade would benefit from that. And it has been a persistent trend that was going on. More money gets attracted to it, more money gets put into that trade. But at its core, it is selling options on the index and buying options on the individual component stocks that make up that index. And the differential between the two, historically people bid index vol higher. Because if you're a long only portfolio of stocks, which is what most of the market is, your tendency would be to buy insurance at times, and that's buying put options on the index. So historically, that trade would have made money because there's a premium in the index vol, and you can replicate the exposure with a component vol. The trade can also make money if the two start to diverge the way they have been doing. The correlation goes lower. And even though index vol has been coming down because of this boomer candy or whatever you want to use the name for it, because people have been bidding, buying those strategies, it's been forcing down the index vol. So you've had to rely on the correlation going lower, which it has been, and it kept attracting money.
Now, are they using delta to figure how many index options to sell and then how many to buy on the components? How does it? Do you know how does it actually work? How is it actually implemented?
Well, I'm sure each of them have their own, highly sophisticated proprietary models for figuring out which components to buy to hedge their index sales and at different times what the weights are and things like that. I don't, it's not my world. I don't know exactly their algorithms or how they build that, but I do know generally what the trade is. I do know that it has become very popular, and it's become so popular it's hit the when it starts to become the subject of Bloomberg articles and Wall Street Journal, and you hear brokers talking about the trade, you generally know that this is something that's become very prevalent. You don't need to know the exact mechanics of how it works to know that the core of the trade is selling the difference between the index and the component vol. And the fact that it can make money two ways. One is the index vol is either higher generally than the component, or the correlation between those two starts to diverge. The correlation within the index starts to diverge. So you've got, that correlation is what's been driving, the decline in that correlation has been what's driving the returns on that trade, because the vol itself has come down. And the effect is that it became a hidden source of danger of being short that index vol. So there's more people shorting that and pushing the risk like further out on the spectrum. I'm trying to think of a good way to describe it, but when you have an extreme market event, correlations tend to go up, and they tend to go to 1, because there's a desire to seek liquidity in the market. It's not about individual company performance or whatnot. People just need money and they sell, and all the correlations go to 1. And that's why I said that trade in its essence is a short tail risk trade. Because when you have an extreme event, correlations tend to go towards 1 and everything sells off. So when you're betting on correlations being low, it tends to be a short tail risk trade. And that is more or less what played out here. But
Okay.
and I think when we saw that Volmageddon event occur, it definitely struck me as someone in a very leveraged type of position being forced to unwind. What the specific position was, I don't know. There's a lot of speculation. You read all different sorts of articles about it, but I know the effect of what it did, which was to drive the implied volatility market much higher, but we didn't see any corresponding moves elsewhere in the complex. We didn't see credit spreads widen. We didn't see that happen. We didn't see the S&P collapse 15%. That didn't happen. All we saw was this isolated issue in the volatility market itself, which my instinct is it had something to do with these type of institutional trades. This was one that has gotten popular enough to become the subject of Bloomberg and Wall Street Journal articles.
Okay.
That's my semi-outsider's view on it. But it was the type of thing where we benefited from the event. It wasn't something we planned for. It was just something that we knew we had positive exposure to if it were to happen, but it wasn't a requirement for our position.
How big of a position was it for you guys? This
it was we had about 12.5% at inception.
So you run a concentrated portfolio.
Yeah, our portfolio in general is very highly concentrated. Generally, always less than 10 positions. Generally, more like 5 or 6.
Is there anything you guys like to add on this about this trade? Did we miss anything here?
The only thing I want to close with, and I don't know, if Brian has some different thoughts as well, but I've been trying to stress it, throughout the conversation while we've been talking. But we look at these things in as practical a way as possible, and I don't want people who listen to this come away with the impression that this is something that requires advanced mathematics or physics. These are really just thinking through what you see, thinking through what is driving people to take different actions in the market and the consequences of it, and trying to reverse engineer what happened because of it. And we see that in a lot of different places. I mean, the thing that we focus on most often is distressed investing, and it's often in the debt piece of the capital structure, and options. And a lot of times folks think, well, these don't really have much to do with each other. but they really do. And when you think back, so this entire concept that we talked about with delta hedging and replicating an option with a delta position, that is the origins of really modern option theory. And when you read the original Black-Scholes paper, 1973 paper that establishes that concept, which is this idea of arbitrage-free pricing, which is this concept of replicating the option with a delta, that there shouldn't be an ability to arbitrage the price of the option versus the delta value. That's what we're doing here. When you read that paper, most people just remember it for that. But the paper actually discusses in a lot of detail the corporate capital structure as an option structure. And they talk about debt as a put on the assets of the company, and they talk about the equity as a call on the assets of the company. And so when we spoke, we were talking about the Volmageddon 2 event, and one of the things that didn't occur was a rise in credit spreads. So if you normally in those environments, there is actually a fundamental relationship between volatility and the valuation of the instruments. If you think about it, that's what, when we talked at one point in this discussion about path dependency and when volatility becomes very low, it also tends to coincide with increased leverage. And that's the reason why, because there is a relationship between the two. And it's something that doesn't get as much attention as, but it's not something I necessarily, or Brian and I thought of, by design at the outset, but it does make sense. And we kind of arrived at this not by design, but by just the way the markets work. And we don't like path dependency. And we see highly leveraged situations unwinding. That's the opportunity. When we see volatility getting compressed or tail risk being underappreciated, those are really kind of two sides to the same coin as far as I'm concerned.
So you mentioned the company is a call, like the equity is like a call, and the assets are like a put. So, so
the debt.
Are you saying,
the
debt?
Yeah.
So, okay, so the shareholders have like a call option on the equity on basically the upside is what it is, and the debt holders, they have a put.
Debt holders are short.
The debt holders are short the put. Okay, so that makes sense now. So they're short the put. They're making their income, their coupon, whatever, and then if things go poorly, then they lose money, basically, because they're short the put, because they'll get whatever is left that might
They get the underlying.
They get the underlying.
They take delivery.
Yeah. So they might, what they get might not, make them full, essentially. Hence the short put. Oh, that's cool. I haven't thought, it took me a little bit to think about that. So
yeah. When most people think of the Black-Scholes paper, they don't think of that. And then there's, in the following year in '74, Merton wrote, a paper that took it a step further and used it as a way to price credit explicitly. But, that's really the link between the two, between options and the corporate capital structure.
Now, I understand that we've talked. I don't know if you want to touch on this at all, but in our conversations also while we were having a beer and clusters with a few other people, you're mentioning how you think about tail risk and how you guys try to hedge for that in a very simple using out of the money long puts. Maybe it would help listeners.
Sure. You want to talk about it a little bit?
Adam said it best yesterday when he said, "Look, we're buying CAGR insurance and
compound growth. We're insuring our compound growth rate.
We do that by buying. We're actually not just buying out of money puts. We're buying out of money put spreads." And we do it, kind of out on the curve, so near term as well as all the way out.
Because the only reason I'm mentioning this is because you know, you guys found this fantastic trade, which worked out very well, and that trade can appear at any point in time again,
Mhm.
where you can put it on again. But then, you know, if you think buying the out of the money puts, you know, in my little head, I'm thinking, oh, well, you know, that's a cost, and you know, I'm going to be
It is a
bleeding
cost.
all
And
this return. But you just said you're putting on a put spread, sort of, I guess, in a way to minimize that cost.
well, it makes it lower cost, but look, we know it has a cost, and we're willing to pay that explicit cost because we have convinced ourselves that avoiding those losses is the most important thing. And the only way you can do that is by buying insurance against it. So we know it's an explicit cost. We have them on. We're using them to insure the rest of our portfolio. And our belief is the rest of our portfolio will perform enough to counteract the premium we have to pay. But like when we view them as a sunk cost when we put them on. Now, if the market dumps, you'll get paid out on that insurance. And the nice thing is like that fills your coffers up at exactly the time where there should be the most opportunity in the market.
For a value investor, for a distressed asset investor, the way we are.
So, as I understand, because you're running a concentrated portfolio where you are generating alpha on those positions, that alpha is what's allows you to also pay for these put spread position. So if you're I don't know, some big fund which has like 2,000 stocks and at best is making market return because it basically owns the market, then they're in a much worse position because they're having this cost and they're not generating alpha.
Well, generally that's correct. The thing that you have to think about though, that's and you see this, some of the folks who write about this, like Mark Spitznagel, has done a lot of work on this, and his books, he'll go through and do hypothetical back tests of this type of a programmatic tail risk strategy on S&P, just like a generic S&P 500 portfolio. And the fact that the S&P 500 has had such strong performance about buying the dip. So if you have money coming in on the tail risk, even though it has a cost to it, the value of the dip buying that you can do when you get new capital injected off of the tail risk payouts more than offsets it. But that's, in my opinion, more a dynamic of how the market has behaved over the last, since the financial crisis.
Mm-hmm.
If you had a sideways market, if you had a 1970s type go nowhere market, I don't know necessarily that it would be as beneficial.
Mm-hmm.
Our approach and what my experience has been over the last 8 years or so in this is generally been not investing in anything that looks like the S&P 500. It's generally has an extremely low beta to the market, and in general, the opportunities are in the distress space, and the better the opportunities show up after a market crisis. Right now, for example, one of our favorite positions is that Brian and I have is in Silicon Valley Bank holdco notes. This is an opportunity that came about because of the banking, that mini banking crisis that happened. And it would have been great if the market had, the whole market had, well, I shouldn't say it because it would have been great for us if the whole market had collapsed at that point, and we would have had a payout on the tail risk hedges, and we could have gone shopping for, all of the things on sale. But as it stood, we took some of the cash we had in the account, saw the opportunity, bought the Silicon Valley Bank bonds. But if there is another great financial crisis, if there is an event like that, if there's something even as there was in 2022, a repricing of inflation risk, these kinds of things allow us to find opportunities, bring capital into the account, and it gives you not just protection against the downside and avoiding the losses that destroy your compound growth, It gives you the ability to supercharge your compound growth by buying the best opportunities when they actually show up.
So I guess it's also a matter of like, if you're fully invested, then you sort of have this sort of insurance going on to help you raise capital when things go bad, to increase your position. Um, I guess at the same time, if someone was receiving a salary every month, they could just use that new cash in a similar way.
Yes.
Just I guess the average investor versus
You could though, but at the same
fund.
time, the rest of your portfolio don't. And
Yeah.
so
But I can see it because what would usually happen for a fund is market drops and then you just have redemptions rather than new money coming in. So there's a difference between a professional fully invested fund versus an individual investor. So I guess in this aspect, this is where the individual investor actually has a huge advantage versus the professionally managed
Or a firm like
fund.
Berkshire. Or a firm like Berkshire that's always bringing in capital off of the float. So there's a constant inflow of capital that they can invest. They probably, at any given time will have, you have a market dislocation and the opportunities start to present themselves, they will always have liquidity to put to work in that. And the risk is what you're describing, which is most managers, though, who have a fixed capital stack with redemption risk. And their investors, when a crisis hits, need capital themselves for their own obligations. So they're gonna get hit with redemptions, whether they like your strategy or not. They're gonna need their own money back to meet their own liabilities. To me, that audience, and it's a very difficult balance, because like you said, if you're managing to an index and you can't take a 200 plus basis point drag on your returns for that, you may not be able to make it work.
it goes back to the difference in our return objectives. Like we, would be satisfied with risk-free returns as long as our risk was taken care of, as long as we had those embedded options so that when things work out, we make a lot of money. If you're managing another fund that's a regular mainstream mutual fund, you're tied to that index. And so, you don't want to buy tail risk insurance because it's going to put a drag of a couple percent and you're never going to beat that index. But we would look at it as, look, if the index is down 20%, even if you beat it by 500 bips, that's a bad year. That's a really bad year. And it's going to kill your absolute returns over long periods of time.
Right. I mean, our goal is not to match an index, it's to compound growth over a long time horizon. And to do that, you really have to avoid permanent capital impairment. We may have a lot of the instruments we trade in or invest in, are these illiquid bonds, things that may have, at some point the mark to market on those isn't as meaningful as what you're actually going to recover in cash out of it. So we may see mark to market drawdown as we accumulate a position in a company that's going through distress, knowing that this bond will turn to cash as it goes through bankruptcy or something like that. We're okay with that type of a situation. It's the scenario where you have a big drawdown in a stock like the classic example is like a Cisco or something, where you bought into it at the top of the market, thing crashes, and then it takes a decade or more for it to recover its value. Those are the things we can't. That's the type of thing that destroys your compound growth. If we have a mark to market, showing mark to market drawdown on like a Silicon Valley Bank bond position, we know ultimately as we get recoveries out of the liquidation trust and something like that, we know the return we're going to earn on that, and we're comfortable with it. The risk is a crisis. The risk is something that would impair a recovery, that would cause the whole position to fail, that would cause us to permanently lose capital, and that's what the tail risk protects against, as well as gives us a bankroll to go shopping with.
Did your tail risk hedge produce any profits?
Well, that's the interesting thing, right? And that's what we were talking about. It is the Vega on it blew out. And so we had this huge P&L that showed up for a few hours. And, because that vol event was not sustained. It was, basically right at the U.S. Open of the market, it came back down. And the thing that you would have expected to see normally would have been a major down move in the price level of the market. And then we would have had real sustained value on the tail risk, but we did not, because the market did not fall like that. So we had this, temporary spike.
Yeah, it was surprising for me because I like you, I think, expected both of these things to blow out at the same time. So a spike in VIX, would have been correlated with a big, deep drop in the S&P 500, and that didn't occur. So it was a very ephemeral gain on our tail hedges. And, they went back to kind of where they were trading. That's okay with us.
Right.
Because they're there for a different purpose.
Right.
Okay, so you kept that options trade on.
Yeah,
the tail risk.
Yeah. I mean, we're not, like I said before at the beginning, and it's easy to mix these concepts up because everybody uses the same name for it. Everybody just says volatility. But, we're not trying to predict the path of implied volatility. We're not trying to predict the path that the VIX will take. We're just buying different things for different purposes. And in the case of the tail risk, we're buying insurance. We're buying insurance on our compound returns. And in this other instance, it was truly a value trade where we saw an opportunity to buy the daily range at a price below where it was actually coming in. And it was just, a happy coincidence that this Volmageddon happened to occur while we had that position on, and we got some benefit from that. But it was not part of the plan. And for the tail risk, it likewise is not necessarily part of the plan. Now, other people do employ strategies to hedge tail risk using VIX and using options on the VIX. Our experience is to use this structure, these out of the money. Generally, we target 30% drawdown in the S&P.
So you use the index options, not the SPY options.
Generally, I like those better for this purpose. And also in the past, we use interest rate options.
For the trade we talked about, did you use the SPY options or the SPX?
SPY.
You're talking about the volatility trade.
Yeah, the volatility trade that you guys we talked about.
SPY.
Oh, the SPY. That was the SPY. Is there anything you guys want to add?
My main thing is I don't want people to come away from this thinking we're, doing some magical thing or something that's so complicated that can't be replicated. It's really, at its core, value investment. We found something that was being sold too cheap.
Yeah. So just so I understand, you're not using any sophisticated option software.
Excel. It's just it's just an Excel valuation model that we built for this. It uses the Black-Scholes. We have a Bloomberg terminal, and we could utilize that. I mean, frankly, it's just simpler for us. I know that it's not the most elegant and dynamic way of doing this stuff, but that's just the way we approach it.
Thank you very much for your time, Brian, Adam. If anyone wants to reach out to
so we set up a website so people could see who we are when we talk to folks. But there's a contact page there, and they can send us an email through that. But
I was going to say through that contact page, if people do want to see the Q2 letter, that does a really nice job of concisely explaining this entire trade in the back of it.
Okay. Yeah. So it's ESOINV.com. I'm pretty sure people are going to enjoy listening to this. So take care. Have a good weekend. The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.